Greetings. Today is Thursday, October 24th, 2024. And earlier this week, I was in a meeting with a client when a couple of topics came up that I thought would be worthy of discussing in a broader context. So the first thing I want to discuss is on the screen right now. We have an ETF displayed that has undergone approximately a 10% correction over the last month. Now, would it surprise you if I revealed to you that this is the ETF for TLT, long-term U.S. government bond ETF? So over the last 1 month has undergone a correction of approximately 10%. Let me show you another one. This is AGG. This is the iShares Aggregate Bond ETF. So over the last month, that is also undergoing a correction, less severe certainly, but still both of them are in at least a short-term negative trend. Unfortunately, too many people, whether we're talking about clients or we're talking about industry professionals, too many people in my view bonds as quote unquote safe. I don't think that's really ever been true, but I really don't think it's true anymore. The reality is that over the last 30 or 40 years, we have been in a secular, which means long-term, a secular bull market for bonds. Well, that trend has largely changed. And so I think that might affect what we're going to be expecting from bonds over the foreseeable future. Now, I'm not making any predictions, but here's the main point. The main point is bonds have been very volatile these last several years, and so I would challenge anybody that would say that bonds are quote unquote safe. Now, in this conversation with this client, we were discussing whether or not their older relatives should move into a quote unquote more conservative posture. Well, traditionally, most people would consider a conservative posture to be heavily invested in bonds. But again, if you're looking at something like long-term bonds and you have to go through a 10% correction in the course of a month, is that really safe? Is that really conservative? In our view, we view risk as the risk of losing money. So it doesn't matter if it's a stock, if it's a bond, if it's a commodity, if it's in a negative trend, is it really considered safe? So this is why when we are using fixed income in our models, we are still going to apply tactical decision making to what we buy and how long we are holding it for, etc. Because in our view, there is no such thing as a quote unquote safe investment. The next thing that we want to discuss briefly is the recent rise in the 10-year yields and why that has allegedly taken place. So on the screen right now, in blue, we have the yield on 10-year treasuries, and then the green line represents the effective funds rate. You know that Chairman Powell and the Federal Reserve recently cut interest rates, so that's why you see that green line step down. But why has the yield risen? Well, some are alleging that the battle with inflation is not yet over. That's probably where I would land on this, because I'm not convinced inflation has gone away really just yet. I think there's more work to be done. But if you search the news, some people are alleging that the 10-year yield has risen because one of the political candidates for president is making comments and their economic theory is going to rise the national debt. Well, here's one of my favorite charts. On the screen right now, we have the federal debt as a percentage of GDP. Folks, it doesn't matter which president wins the White House and who's controlling Congress. They really need to get their act together and get our spending under control. Our debt is now 120% of GDP, and that is way too high, and that can easily cause economic problems down the road. So whichever candidate wins the White House and whoever is controlling Congress, I'm certainly hoping that whatever the policies that they're going to put forward, it is going to help bring down our national debt. The last thing that we want to talk about is, in general, filing the news. Okay, and what do I mean when I say file the news? What I mean is, generally speaking, ignore the news. Now, that's not really what I mean, because I do think you should be aware of what's happening both domestically as well as globally. You should have an awareness of the geopolitics and things of that nature. But in our view, that should not color your investing decisions. Why? Because if we go back to one of those other slides, I would show you that the rates have come down, but bond prices have also come down. Well, historically, bond prices and interest rates are inversely correlated. So recently, the interest rates went down a little bit, but so did the bond prices. Well, why? They're usually inversely correlated. Well, the problem is the stock market and the bond market is making decisions, and people are making decisions about what they expect to happen. So bond prices have been rising this year because it has been very well forecasted by Chairman Powell and the Federal Reserve that they're very likely to cut rates. So in anticipation of that, bond prices have risen. So this client that I was talking about earlier this week is concerned about one of the political candidates running for office, and I get it. It's a very divisive nation right now, and it has been for a while, and I pray that that stops. But the reality is we're going to follow price. It doesn't matter if this particular candidate wins the White House or this particular party wins Congress. It doesn't matter. We're going to follow the price and what's actually happening. That is why we make decisions and why we review things as often as we do, because we might think this is going to happen, but if it doesn't actually happen, I don't want to take any action until it's actually happening. So on the screen right now, we have SPY, which is the traditional cap-weighted S&P 500 ETF, and on the right we have RSP, which is the equal-weighted ETF for the S&P 500. What I really want to highlight here is the fact that we have seen 1, 2, 3, 4, 5, 6 weeks in a row of rising stock market as measured by these two ETFs. So the fact that this week is a little bit of a negative week really shouldn't be all that shocking. The stock market never moves up consistently without ever any temporary pauses or temporary pullbacks. What we're experiencing right now, from our view, is very, very natural, and I really don't think it has anything to do with politics. In general, don't let your politics influence your investing decisions. Let the stock market, let the bond market, let the prices dictate what you're doing and how we're reacting. And that's what we do, and we do it every day. And if you have any questions, by all means, feel free to reach out to me or my team. We are more than happy to see if we can add value to you and how your nest egg is managed. Thanks for watching, and tune back in next week for the monthly market monologue.